This is an interesting one. How risky can I be with my Roth IRA? Now, this actually came from a different question. I'll read the question as it was written, and then I'll go ahead and summarize it with the question that I came up with it for. But how dumb is it to use the Roth IRA for speculative, aggressive, risky options, knowing full well that it can go to $0, since one can sell off and transition to conservative investments with no tax hit? Like, if it's going to grow aggressively, might as well grow tax-free. I might have abused TQQQ in a previous life. I no longer hold that, but I kind of feel the itch to put a crypto ETF in my Roth this year. Parentheses, 95% of my investments are boring ETFs. So I summarize it as this. How risky can I be with my Roth IRA?
A quick comment. TQQQ is risky. It's like a leveraged version of the NASDAQ. NASDAQ has done really well, and if it's leveraged, it goes up really high, and when it goes down really high. And it's not designed for long-term investing. It's designed for like really short-term, like 1 to 2 day max hold periods. Like you're not supposed to be investing in this. This is for traders, not for investors. I would not, under any circumstances, advise using something like that in a Roth IRA that we're investing in for the long haul. It's just not wise. His point, however, about risk is an interesting one because in theory, and so I'm going to break this in two parts. Deal with risk and how aggressive should we be or how conservative should we be, and then does the kind of account influence the amount of risk we should be willing to take? So a traditional IRA, a non-retirement account, or a Roth IRA, does the use of that particular account type influence how much aggressiveness one should be willing to take? So first, on risk, you have to be careful. Are you a speculator or are you an investor? I think that is a fundamentally important question. Why are you investing? Well, Tim, I'm investing because I want to have compound interest working for me. And if I put my money in these things and it compounds and grows, then I will be able to retire someday. And that is a legitimate concern. That is a reason why we invest. We want to use compound interest in our favor. But there is more to there's more to investing than simply the growth potential, because it's really easy if we're only coming to it for its growth potential to enter into or veer into the area of speculation and gambling. Now, I have to say, in every kind of investment, there is something speculative to it, right? Because there is no guarantee of a positive outcome in any investment. Every investment involves a degree of risk. So whenever you take on risk, we are speculating that the rewards will outweigh any potential risks. I acknowledge that. When I say to be speculative, I'm using that more as a synonym to gambling than I am to the just the general idea of risk-taking. I would say risk-taking is right. There are biblical principles that we see in Proverbs and in the Gospels that indicate that risk is wise. The proverb, I can't think of the one right off the top of my head. It says, the lazy man says, I can't go out in the street. There's a lion that will devour me. Think about that. The lazy man. That tells us that this person's biggest problem isn't fear of risk. It's not wanting to take out the effort to go outside for some kind of trumped up fear that there might be a lion in the streets of the city that's going to eat him. Okay, that's laziness. That's not wise. Risk taking is wise. There's a certain amount of a divine, good, godly risk taking that we should take. We can look at the talents of the parable of the talents. Yep. In the parable of the talents, we have 3 people, 2 of which took risk and were rewarded. One of which took no risk, buried in the backyard, and was punished severely. And I know the primary reason that Jesus told the principle of talents was not to tell us about how much risk we should or shouldn't take in our 401ks and investments, but it does show to some extent that risk avoidance, to the exclusion of demonstrating wisdom and prudence, is itself evil. There's a reason why he was cast out and punished severely. So risk is required when we invest. How much risk should we take? That is a difficult question to answer. I can say this. I have had people who are in their 50s and 60s who are kind of behind the eight ball, so to speak. They're behind the curve in their savings, and they feel like they've got to make up for lost time, and they're willing to take on obscene amounts of risk in order to make up for lost time. So I had a guy who only wanted to invest in BRIC. That's Brazil, India, Russia, China companies. And this was back when BRIC was one of the hottest trends in investing, kind of like the FANG stocks or whatever, the Fantastic Five as it kind of is today. We look at those as like you can't go wrong by investing in those companies. He wanted to invest in only those BRIC companies. And I'm like, come on. I understand that you're behind the eight ball, but at some point taking on obscene amounts of risk is not actually showing a proper, wise trust in God, because I don't feel it's actually prudent. Because the potential of a negative outcome outweighs the negligible chance that you're going to invest in here for a long period of time and it's never going to have a bad outcome. So we trust in God. We take prudent steps to address risk, which means that for many people, we need to be diversified. And I would say one prudent way of doing that would be to use something like a mutual fund or a boring ETF. I know they're boring, but they're boring for a good reason. We're diversified. We don't have all of our eggs in one basket. If one company goes belly up, it's not going to blow up the rest of it. If you invest in single stocks, the risk that one of your companies goes to zero is not a non-issue. It's a potentially significant risk. And if you're over-concentrated, it'll have an oversized impact on your portfolio. So be wise with your risk. I recommend diversity. Diversification doesn't eliminate or remove risk. It just removes certain kinds of risk. The single stock risk. If the market all goes down, if the market all goes up, your ETF or your mutual fund is going to go with the market, right? With those particular bucket of stocks. So yes, I think we should take more risk than perhaps we're willing to take. I think that's one of the fallacies many of my clients, if I could encourage them to do one thing, it'd be actually step out a little higher on the risk spectrum. But within reason, right? I've got some people who are well out there on the income or the asset spectrum that don't need to take risk and maybe want to take more risk than perhaps they should. And that's something where we talk about, like, what are the potential positives and negative outcomes, and is it worth it? Right. However, on the flip side, there are plenty of people who are saying, I don't want to lose anything. Therefore, I don't want to take much risk at all. Therefore, they're not going to keep up with inflation. Therefore, they're not going to really invest in companies that are making the world a better place. And that's where I've got some challenges. I would love to invite them into trusting God, taking a little bit more risk, but also risk that is prudent and wise. The next phase of the question is, does the account type influence what you do? Because Roth IRA is entirely tax-free. Here's an example of something that is no longer legal, but a guy went out and took shares of his company that was not yet public, that had a very low valuation, pennies valuation, bought it in his Roth IRA, and then the company went public for billions of dollars, and he has this $1 billion Roth IRA, which is totally tax-free, right? That entire scenario is off the table. The government said you can't put non-public traded equities or assets in a Roth IRA. It's got to be publicly traded stock, bond, mutual fund, ETF, things of that nature, right? That's off the table. The guy who did that, super smart. I mean, if you can turn your money into some tax-free thing, this guy was brilliant. But it's not an option. I don't know that it really matters. I think the risk question is more important than the account type. The risk does, like, there are different kinds of assets you might want to hold in one type of account rather than another. For example, equities, stocks in a taxable account are probably better than bonds in a taxable account, because bonds are less tax efficient than an individual stocks you can control when you sell your stocks in a taxable account. And you get capital gains treatment on it. So better tax rate than just the dividend rate. Dividends tax as ordinary income. So there are caveats with that, but the Roth IRA is a great place to take risk. The traditional IRA is a great place to take risk. I don't think that the account type itself really should have too much sway on what you invest in. It should be bigger about what you want to do and the kind of risk you want to take as an individual, recognizing that at the end of the day, we're trusting in God. Whether everything works out or it doesn't work out at all, God has promised to meet your needs. He will likely use the assets you have as a part of the answer to that meeting of your needs, but if they're gone, He will provide regardless. So I think take a little bit more risk is probably more right than be a little bit more conservative. But again, with wisdom, all in perspective, right?
Amen.
That's why you got to work with a financial advisor to work with you through figuring out what's that right risk-reward balance.
Yeah, no, that's huge. And the reality is the financial advisor you decide to work with has seen many people come through and have seen the situation that you're going through probably a dozen or more times. So it's not something that's new to them. Whereas for you, this is your first time being the age you are. This is your first time being in the situation you're in.
That's right.
A seasoned financial advisor, or even a financial advisor that's surrounded with a team, they can speak into your situation with a lot more wisdom than perhaps you can just guess at. So that's super helpful, Tim.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. Securities and advisory services are offered through Genius Wealth Management, member FINRA and SIPC.